So, good day, guys. Welcome to today's class. If this is your first time on our YouTube channel, please ensure you click the subscription button down below this video. Click subscribe and click the notification button so that when we drop more educative videos like this, you'll be able to get access to them. So, as you can see, what I have here on the board today, we'll be introducing ourselves to taxation. So let's start with what do we mean by tax. When we say tax, what do we mean by tax? What's the difference between tax and what we say taxation? There are two different terminologies we need to look at. What do we mean by tax and what do we mean by taxation? Now, what is tax? Tax is a compulsory levy imposed on all citizens that is meant to be paid. So whenever we talk about tax, we mean a compulsory levy that the government make compulsory for the citizens to pay. So actually I don't have the definition here. I will have given you guys what I have here. So but that's what the meaning of tax is. So tax is a fee. So far you are in a city, in a country, and you work, you earn money, you are meant to pay tax. So, and this topic tax is actually a very, very wide topic. So that is why it is one of the courses you'll be doing in ATS 3. One of the courses you'll be doing in ATS 3. So now, what's now the difference between tax and taxation? Now, tax is a compulsory fee. You need to put that word, compulsory fee, that is levied by the government on the citizens of the country. Provided that they have source of income. So that's what we mean by tax. But what do you mean by taxation? Taxation is the process of imposing tax. So the difference between taxation and tax is that taxation is the process, tax is the money that is being paid. Taxation is the process, tax is the money that is being paid. So let's now look at what are the reasons why government impose this tax. What are the reasons why government imposes that? We call that objectives of taxation. Of taxation. Why do government impose tax? That's what we mean by what? Objectives of taxation. Number one major objective of taxation is to reduce inequality. To reduce inequality. What do we mean by inequality? In a country, for example, now you have those that are extremely rich, those that are very poor, those that are just they are not rich, they are not poor. You have those kind of people in a country. So there's something we call progressive tax. When we get there, we will explain. So those that are having higher revenue will be taxed higher. They are going to pay higher tax. Those that are having lesser revenue will be going to pay lesser tax. So they are trying to bridge the inequality. The rich is having, for example, now the rich is having 100,000. The rich is having 100,000. The poor has 20,000. So at the end of the day, after imposing tax, the rich is meant to pay, let's say for example now 40,000. Now if you subtract, you are left with what? 60,000. Why the poor is meant to pay 2,000? It's meant to pay 2,000. So if you subtract, you have 18. So if you see that the gap before the tax, the gap between the two is 80,000 naira. That's a wider difference. But after imposing the tax, the difference is just very, very, very small. If I'm not wrong now, 60 minus 20 should be 40. That should be 32,000 naira. So what has happened here? The government has reduced inequality. So to reduce inequality, another reasons why government impose taxes so that they can create services. To render essential services. Should I say services, or I should say so that they can provide infrastructure? Infrastructural reason. So another reason why government impose tax is so that they can build bridge, ensure good water flow, all those things, all this function of government. So in most cases, taxation is the major source of revenue to the government. So according to what I have here now, I have generate income. Yes, so that the government can generate income, the federal government can generate income. That's another reason. So they can generate income generation, or generate income. So they impose tax so that they can generate income. Yes, improve infrastructural facilities. Yes, so all these are the reasons why the government of a country will impose tax on its citizens. So far you are working and you are within the legal age bracket, you are meant to pay tax. So we are going to be looking at some other divisions, and some other things under this tax. So follow me as I take you on the journey to learn taxation. So the next thing we are going to be looking at is the principles of a good tax system. Yes. So what do I mean by the principle of a good tax system? Is that it means that how do you know if the tax system of a country is actually good, is actually okay? So there are some principles the tax system of every country must meet. If it doesn't meet it, then you say it is not a good tax system. But if the tax system of any country, Nigeria for example now, if the tax system of Nigeria meets this criteria I'm about to write for you, then you say Nigeria has a good tax system. So how do you identify a good tax system in every country you go to? Number one is that it must be convenience. Yes, it must be convenience. So whenever you are talking about a good tax system, it must be convenience to the taxpayers. Yes, those that are paying the tax must not be like, it must not be a burden to them. It must be something that they are there. When we say convenience, it is a rate that will not be too much on their income. So when something is convenient for them, so for a principle of a good tax system, one of the principles is conveniency. It must be convenience. So going by what I have here, I have certainty. Yes, certainty. What did I mean by certainty? Certainty means that there must be a specific period where tax will be collected. Not that you collect tax in a month, another one in the next 4 months, another one in the next 30 months. So it is not like that. It must be certain that yes, you will collect this thing. Not that it must be within a given period of time. Taxation. So it's number one is that it must be convenience for the taxpayers. It must be certain. Another one is that it must be economy. What did I mean by economy? Like economy means that, for example now, for a good tax system, economy means that, imagine, for us to be able to collect tax, we are going to spend money. I hope you know that. Yes, what did I mean by we are going to spend money? Government is going to spend. Spend in what sense? Spend in the sense that if, to amass people's tax, government needs workers that will go out there, check their book of accounts so that they can know how much they are going to tax and all of these things. Government is actually going to pay them. So imagine if government is paying them 100,000, for example now, 100,000. Economy is trying to say that the revenue that will be generated from the tax should be more than this 100,000. Imagine I paid 100,000 naira to those working for me, and at the end I only realized 60,000 naira. So in this situation, we say the tax system is not a good tax system because we are spending more than we are receiving. So that is what we mean by economy. It must be, we must economize, have income that is far greater than what we spent at the beginning. So going by another thing we have here, you have equity. Yeah, equity. What do you mean by equity? Equity means it must be fair. Yes, it must be fair. It must be fair. So what do you mean by this equity? It must be fair. Let me explain it to you. So being fair means that, look at a situation where we have a rich man and a poor man. Now a rich man pays 20% of his income. A poor man pays 20% of his income. This is not fair enough. Yes, because though fine, we might say they are being charged the same amount of money, but it's not fair. So this is not fair. Though they are being charged the same amount of money, 20%, but it's not fair. How is it not fair? Because this is not meant to be charged 20%. is a low income earner, this one is a high income earner. This one might probably not feel the burden of the tax, but this one will feel it more. So it is not fair enough. So there are two types of equity. For it to be fair, equity must meet two different criteria. So under equity, we have two different things. We have the vertical equity and we have the horizontal equity. Now let me quickly explain this. What do you mean by vertical equity? What do you mean by horizontal equity? Now, whenever you're talking about vertical, we always indicate it in this way. Vertical. Yes. We always indicate vertical in this way. Now, this vertical equity is saying that for us to be fair, if you look at this now, this is in graph, we call this the y-axis. Yes, we call this the y-axis. And it always starts from the origin of 0 to, let's say, 2 to 4 to 6 to 8 to 10 and so on. Now this one is saying that the vertical equity is saying that for us to be fair, those that are receiving higher income should have higher rate of taxation. Those that are receiving lower income should have lower rate of taxation. That is what we mean by vertical. Telling us that those that are receiving higher income should pay more, and those that are receiving lesser income should pay less. So, for example, now as if the pot that's receiving 100,000 might pay a 30% tax, while this one that is receiving a 2%, 20,000 might just pay 5% tax. So that is what vertical equity is trying to tell us, that for us to be fair, we don't need to charge everybody the same rate. No, that is very wrong. We need to charge them according to the salary they earn. So now looking at horizontal is like this. This is horizontal line. So horizontal equity is telling us that those that are receiving the same, you can see that when you say horizontal, on the same level, on the same edge. So it's telling us that those that are receiving the same income or similar income should have the same rate of tax, irrespective of maybe I'm married or I'm not married or anything. They should have the same rate of tax. Now, looking at, for example, now let's say a teacher now that earns 100,000 naira and a farmer that makes a revenue of 100,000 naira. I should not say because this one is a teacher, let me charge 10%, and because this one is a farmer, let me charge 2%. No. So far they are receiving similar income, then they should pay the same taxation. So that is what horizontal equity is trying to tell us. Principles of taxation. It must be convenience, certainty, economy, equity. So horizontal trying to tell us that those that are receiving similar income should be taxed, receive the same rate. Why those that have higher income for vertical, those that have higher income should be taxed higher, and those that have lesser income should be taxed lesser. So let's look at some other things about taxation. Like I said earlier, taxation is a very wide topic, but you have come to the right channel. We will demystify everything for you so you can get it. So just, if you have not clicked on the subscription button, click on it and let's continue with our class. Now let's proceed. Another thing we'll be looking at under tax is the classification of tax. Yes, let's look at how we classify tax. Actually, according to classification of tax, we have two different types of tax, and I'll give it to us. We have the direct tax, and we have the indirect tax. Yes, we have the direct tax and the indirect tax. Now, what did I mean by a direct tax? Okay, let me go by what I have in my notes here so that you guys will get the definition. A direct tax, according to what I have here, I said this is a tax levied on payers' income. It is a tax where there is no shift in tax burden. Let me drop that. Let me explain it so that you will get it. Explanation matters a lot. Now, when you say a direct tax, there are some situations. Let me first explain indirect tax, and then that will help you get a direct tax very well. There are some situations whereby if I tax you, for example, now I'm a seller. I deal in selling markers. Now, so government tax me 100 naira, and I am producing 10 markers. I produce 10 markers. 10 markers. Now, out of these 10 markers I produce one each of them. I produce each of them at the rate of 100 naira. So definitely I produce the 10 markers. If I produce 10 markers, one marker to be 100 naira, definitely I produce the whole 10 for 1000 naira. So 1000 naira for 10 markers. Now, if I want to charge my price, you all will believe that since I'm producing one to be 100 naira, then definitely I should charge a price that is more than 100 naira, like let's say 110 naira. So my profit on one is 10 naira, right? Now, but government now said I should pay tax of 100 naira. In this situation, because I'm paying tax of 100 naira, and I decided to increase the price of my products. Now, you know, I produced 10 markers and I decided, okay, well, let me share this 100 naira on the 10 markers. So if one marker, I'm producing one marker for 100 naira and I share the 100 naira my taxation on every marker, definitely I'll be giving each marker 10 naira. So my cost of producing one will now be 110. So if I want to set my price, I will set a price that is above 110 naira, so that I will be able to cover the amount at which I produce and at the same time the taxation. So that is what we mean by indirect tax. And indirect tax is a tax that the person that is being taxed is not the person that will pay the tax. Let me give you a good illustration, another good illustration. Sometimes when you make calls, when you make calls, you always see when they give you the seconds and everything about the calls you've made, you see something like VAT. Yes, you see something like VAT, value added tax. They'll tell you that VAT, let's say, is 10 naira. You are the one that makes the call, fine, but are you the one that the government has taxed? No. Government actually tax your service provider, your network provider rather. Government tax your network provider, but your network provider is sharing that cost to you, so you have to pay part of that tax. So in that situation, you are not the one that has been taxed, but you are the one paying. In that situation, you will say that is an indirect tax, because the person that is being taxed is not the person that is paying. So, and in most cases, indirect tax is always on consumable goods that we want to resell, goods that we want to sell, all those things. That is what indirect tax most times do fall in: consumable goods and services. So why direct tax is a tax whereby the person that is being taxed is the person that will pay. Government tax me, and at the end I'm the one paying the tax. For example, now I receive 100,000 naira. And government tax me 10%. Now if I'm to pay 10% out of 100,000, definitely that will be 10,000. Then this is a direct tax, because government tax me and I'm the one that's still paying. It was still removed from my salary. I cannot pass it to any other person. Then this is a direct tax. Indirect tax, you can shift it to your buyers. You can share it to your buyers so that they will pay for the tax. But direct tax, you can never share it. So that's the difference between direct tax and indirect tax. So we now have some other terminologies that we like to introduce to you guys. We have what we call tax base, tax rates, tax yield. Let's look at everything. Taxation is actually wide, but here we demystify everything for you. Let's continue. Yeah, but before we proceed, I forgot to give examples of direct tax and examples of indirect tax. So example of direct tax, we have personal income, company tax, and so on. Let me see if I have any other okay, payee. Yes, payee, pay as you earn, and so on. All these are examples of direct tax. But when we say indirect tax, and that is one thing I want you guys to observe. One that I want you guys to observe is that direct tax are more or less like tax that it is falling. The person that is being taxed is the person that we pay. And if you look at all these tax, it's more or less like something that you cannot shift to another person. Nobody will share the burden with you. You really want to carry the burden yourself. But indirect tax in most cases is all about goods or services that is being rendered. Yes, any tax, the idea or the ideology behind this thing is that any tax that is based on goods, I say that you are saying that this thing is related to goods like export duties, yes, import duties, sales tax, value added tax, tax like that are on goods and services and all those things. So in that situation, it's an indirect tax. So even if you can differentiate between them, just ask yourself that which one is on goods, which one is on consumable things, which one is on services, then that is an indirect tax. But if it is not, then it's a direct tax. I hope you all understand that. So let's now look at some terminologies here. Terminologies under terminologies terminologies. So there's some terminologies we are going to look at. You need to know some tax terminologies that we use. Number one terminologies I'll be introducing to us is what I call tax base. Tax base. Now, whenever you hear the word tax base, what do we mean? Tax base, tax base simply means the thing or the particular item that is attracting tax. We call it tax base. A good example is, for example, now I sold this notebook. Now I bought it 100 naira and I sold it, or let's say I bought it $100. Yes, let's use dollars. I bought it $100 and I sold it for $1,000. Now from $100 to $1,000, then I pay the tax of, let's say, 5%. The question is, what attracted tax? It is actually this particular book, right? Then this book is the tax base. The item that is being taxed, the item that attracts the tax, is what we call tax base. So if I'm paying a property tax, then the tax base is the property, because that is what attracted tax. If I don't have this book, I will not pay tax. If I don't have the property, I will not pay tax. So the item that attracts the tax is called tax base. Actually, we have three major things that government can tax. Yes, three major things, but that is not important right now. When we dive further in taxation, you will get it right. So another one is tax rates. Tax rate. Tax rate. What do you mean by tax rate? Tax rate is the rate that you are paying, the rate of tax you are paying. Yeah, we call it tax rate. If you are paying 2%, you are paying 2%, you are paying 5%, you are paying 8%, then the rate is what we call tax rate. And lastly, we have tax yield. Tax yield. Tax yield simply means the amount government generated from tax. We call it tax yield. If government had generated $2 billion from tax, then the tax yield is $2 billion, the amount that the government generated. So tax base, the item being taxed, tax rate, the rate of taxation, and tax yield, the amount it yielded to the taxation yielded to the government. So I think lastly for this video we'll be looking at the systems of taxation. Yes, systems of taxation. Yeah, and one other particular thing. So let's look at the systems of taxation that we have, and let's dive. Enjoy. So talking about the systems of taxation, we actually have three systems of taxation. So, and I will start with the progressive system of taxation. Progressive system of taxation. Yes, as the name implies, progress. Progressive system of taxation is a taxation whereby as your income increases, your tax rate will increase. As your income increases, your tax rate will increase. What did I mean? If you are receiving a $10,000 and you are paying 2% tax, you are now receiving a $500,000. You are going to be paying higher tax, like 15%. That is a progressive system of taxation. The graph is always like this in most cases. You see it. This is the tax rate, the rate here, and income here. Yeah, so the rate. So as your rate As your income increases, your rate also increases. As your income increases, your rate also increases. So this is a progressive tax system of taxation. And if you remember when I explained equity, you see that the principles of a good tax system, which is equity, actually follows or abides with progressive system of taxation. Because equity is trying to tell us, if you could still remember, vertical equity is trying to tell us that if you are receiving higher income, you pay higher rates, and if you are receiving lesser income, you pay lesser rates. And this is the same thing that is happening here. When you are receiving a lesser income, you are paying a lesser rate, receiving higher income, paying higher income rate, and so on and so forth. So let's look at another systems of taxation. Another systems of taxation that I will look at is what is titled proportional system of taxation. Proportional system of taxation. So what do you mean by proportional system of taxation? You've been to church, right? And they will tell you that you are meant to pay, irrespective of your income, you have to pay 10% tithes. This 10% tithe is a proportional system of taxation. A proportional system of taxation is a system of taxation whereby no matter your level of income, you are all paying the same rates. You are all paying the same tax rate. Then that is a proportional system of taxation. A proportional system of taxation is always in this way. It's always in this way. The rate is fixed while the income continue to increase. Yes. So if the rate is 10%, if you are receiving $2, it's 10%. If you are receiving $5, it's 10%. If you are receiving $10,000, it's 10%. So that is a proportional system of taxation. So let's look at the third one, which is the risk. So the third one, or the last one, which is actually the regressive system of taxation, is a system of taxation whereby as your income increases, your tax reduces. So this is actually a very unfair system of taxation, and you hardly see this kind of thing being used in any country. What did I mean by regressive? Yes, regressive system of taxation. Regressive system of taxation is the graph is always like this. The graph is always like this. This is the rate and this is the income. So when you have a higher income, you are paying small salary, small rate rather. Let's say this is 10, this is 5, this is 2, this is 0. So this is 1, this is 2, this is 3, this is 4, this is 5 from my graph. So when you're receiving $10, you are paying 2%. When you are receiving $5, you are paying 3%. When you are receiving $2, you are paying 4%. When you are receiving 0, you are paying. So this system of taxation tax make the poor poorer and make the rich richer. So this one is actually against the principle of equity, which tells us the principle of a good tax system. So from regressive, proportional, and progressive. So these are the three systems of taxation we have. So one last thing before we end our class is that there are another two types of indirect tax that I need to bring to you guys notice, because they will always ask you in your ICANN exams. Yes, you always see something like that. So another two types of indirect tax that you need to know is don't forget I said that indirect tax in most cases is always on goods and services. Yes, goods and services, because that is when you can shift the burden. But if you're not selling anything, if you're not doing anything, you cannot shift the burden, then that makes it a direct tax. So let's now look at another two types of indirect tax. We have ad valorem tax and specific tax. What do you mean by ad valorem tax? Ad valorem tax is a tax that is based on the quality of goods. The tax rates under ad valorem tax is determined by the quality of those goods. For example, now imagine I want to export goods or I want to import goods that are worth billions of dollars. Now in these situations, the rate of my taxation will be determined by the value of my products. And that's what we mean by what ad valorem tax. It's just trying to tell us that when you want to tax goods, you look at it. Is it a good of a higher quality? If it's a good of a higher quality, then the tax rate will be determined by the quality of the goods. So that is what we call ad valorem tax. Now, what do we now mean by specific tax? Specific tax is just the opposite. Specific tax is a tax whereby the quantity of the goods determine the tax rates. Now, when you are exporting goods that are of no quality, for example, you are exporting cartons, thousands of cartons from a country to another. Obviously, cartons they don't really have much quality, but they are still useful. Then in that situation, the tax that you're going to pay will be based on the quantity of carton you want to export. That is a specific tax. So an equivalent tax is based on the quality, specific tax is based on the quantity. So from the beginning, from what is tax, what is taxation, principles of a good tax system, objective of tax, and everything, we've explained and demystified everything in this video. If you have any question, you can drop it in the comment section, and don't forget to like, subscribe, click the notification button, share these videos so that others out there that need something like this we actually get the information. Thank you. That is the end of today's class. In case you have any video requests, please don't hesitate to drop it in the comment section. We are going to work on that. See you guys in our next video class. Bye bye. It's a good day.